The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The webinar will begin shortly. Please remain on the line. The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and thanks for joining us tonight. We are going to be presenting really nothing and just fielding questions. So this will be a night where please feel free to ask any questions. We have a list of questions that have been submitted so far. So to kick things off, we're going to go ahead and review some of those. And after we're done with those, feel free to submit some additional questions as well. So hello, Lee, by the way. Thank you. Got your message there. I'm going to go ahead with everybody's permission. Thomas, are we recording now, or do you want me to go ahead and start that on my side?
Yeah, we're recording. We're good to go.
Okay. I'm going to go ahead and just kick things off with a standard disclaimer here. This is something we're all familiar with, but we try to do this just to make sure we're thorough with respect to the risks that are available or risks that are out there with trading. I'm going to go ahead and make my screen clean here. Okay. Now, the initial risk that every trader is aware of is that trading or investing carries a high degree of risk of loss, regardless of whether you're dealing with leveraged instruments like futures or options or just normal equities and whatnot. So please take the time to understand that there is a very real risk of loss when you trade, and there's also obviously a high potential for upside as well. But we're not here to exaggerate the upside, and we're not here to minimize the risk of loss here. So please, if you haven't done so, take the time to really understand that there is a very real risk of loss out there when trading. Now, the other thing that I wanted to point out was that if we ever talk about any hypothetical or simulated results, and I don't know if one of the questions tonight will deal with back testing or optimization, but the SEC Rule 4.41, excuse me, talks about the limitations of hypothetical results. It's important to understand that just because you optimize a strategy on a data history, there's no guarantee whatsoever that you're going to be able to replicate that. In fact, I can pretty much promise you that the markets you're going to see going forward are going to be different to some degree than the ones you've seen going back, but it doesn't mean that the hypothetical results are invalid. It just means that if you see similar attributes going forward, in my opinion, then the system has a higher probability for success. If you see dramatically different market conditions than what you've seen historically or that are contained in your testing sample, then there's a good chance that your system will struggle going forward. So understand there are limitations with hypothetical results and simulated results within any of our presentations or anywhere in the market, and people responsibly should make sure they communicate that. And also lastly, no representation is being made that any account will or is likely to achieve profits, although obviously that's our primary goal with everything we teach and everything we do. Our courses, products, and services should be used as a learning aid, and they're designed for that. We're not giving out investment advice, and we're not licensed, and we don't want to be licensed to give out customized investment advice, nor are we licensed at Microquant, nor do we have a desire to be licensed to take discretionary control over any types of accounts. So just wanted to review that, and let's go ahead and jump right into the questions. Thomas, you want to kick things off?
Sure. We have a question from Jeff, and he asked, what exactly is signal feed?
Okay, signal feed is a way to distribute commentary or signals for really any type of markets. Right now we have, I go ahead and just pull up ValueCharts here. If you go to our homepage at ValueCharts.com, you'll see that we have a heading here under Trading Signals on Signal Feed. And what that's designed to do is that's a product that you can sign up for. This is brand new. We've got a number of other products that are coming online, both from Microquant and other companies as well. But this is a product that is designed to broadcast opinions, broadcast setups, or market opinions or signals that we're seeing or observing in the market. So the way that works is there's actually a executable file that you'll install on your computer. It's a desktop application designed to be broker neutral, and when we broadcast a signal, you're going to see it pop up from the bottom right-hand corner of your screen. And if you click on that, then there's going to be some sort of more detailed commentary. So the signal feed itself is comprised of just different basic signal characteristics or commentary characteristics, very general description of what the signal is. If you click on it, it's going to pop up and give you more information. So that's what signal feed is. All right, hopefully that answers the question.
The next question we had is from Richard, and he was asking, is the live trading room helping people make money, and what do we do in there? You want me to answer that question, Mark?
Yeah, please. Thanks, Thomas.
All right, with the live trading room, first things first, for just disclaimer purposes, it's for educational purposes only, meaning we're not suggesting you take any of the trades that we take. However, the trades that we've been placing over the past 13 weeks, we've been up every single day except for 4 days in the past 13 weeks, and we've never had a down week, which is actually very good in my opinion, pretty nice track record. We're on a roll. We were up again today. So generally speaking, we're not giving you specific trade advice, or we're not telling you you should or shouldn't take a trade, but we do show you the setups that we follow. We explain why we take the trade. We try to educate you on the ways that we're trading the markets personally.
And just to add to that, Thomas has done a super job with the live trading room. He's showcasing the power of the different products that we've developed here at Microquant. And we're not suggesting in any way, shape, or form that that we're going to have another 3-month stretch with just a few down days. we are suggesting that we have a high degree of confidence that our products can help you as traders. We believe that, but understand there's no guarantee of that. And really everything we talk about in the trading room is really for educational purposes only. Our goal is to teach you some trading ideas that we've uncovered that we believe are valid and we believe will help you make good trading decisions. And whenever we talk about whether we're up or down in the trading room, it's really trying to take an aggregate of the signals that Thomas has talked about. So it may not be all of them, it's just whatever we can record, and it tends to be, we believe we have most of them, but it's not meant to deceive in any way, shape, or form. It's just sometimes Thomas will talk about a number of markets very rapidly, and we try to capture all the commentary and quantify that as much as we can, but sometimes it's challenging. So check it out yourself, and you can make your own decision if you're not a member of that. It's in my opinion, I don't know of any better trading rooms out there than that. Thomas does a super job. He's up before most people are in the morning, just really doing his homework, and takes his job very, very seriously. So he has a passion for the markets, and it's a great, great learning tool, in my opinion. All right, next question.
All right, next question we have is, how is ValueCharts different than Bollinger Bands or MACD?
Okay, value charts and Bollinger Bands are actually very different. I think one of the first things we can do is go to John Bollinger's website. Okay, if you go to bollingerbands.com, I don't know if this will be easy to find or not, but he basically talks about Bollinger Bands are a technical trading tool created by John Bollinger in the early 80s. So they're just really a very basic, giving you a basic idea of what high and low are. So reading his description, he said they arose from the need for adaptive trading bands and the observation that volatility was dynamic. Certainly correct statement, not static, as was widely believed at the time. I don't know whoever believed volatility was static, but but he must know of some people, obviously, but by saying that. But I think most people who study the market will see that volatility is constantly changing. The purpose of Bollinger Bands is to provide a relative definition of high and low. Okay, so that's the purpose of Bollinger Bands. By definition, prices are high at the upper band and low at the lower band. So really, John Bollinger created something that, in my opinion, can be very complementary to what we're doing here at MicroQuant. So let me go ahead and just put a Bollinger Bands indicator on our chart here. If TradeStation decides to react to my request here, this century indicator, let's try that. For whatever reason, it's been a little laggy lately, and maybe because I have several desktops open. Okay, let's try this again here. Let's try this again. Okay, insert indicator. If that doesn't work, I don't know why this happens. I just actually installed a new version tonight, so sometimes when that happens, things tend to be a little haywire. Let me do this. I'm going to go ahead and just post this very quickly here and just close my TradeStation down. But just to continue the conversation, I'm going to close my TradeStation down and just open it back up here, and hopefully it'll unstick. But to answer the question, the ValueCharts is designed with the idea of really helping traders understand the valuation of a market. And that's a little bit of a mind bender when you think about value. But value actually is probably the most important variable when describing any market. So when we think of buying a used car, which represents a free market, for example, we think of value as, as we're after the best deal. So we're not after going on a car lot and buying an overvalued asset. In fact, that's one of the easiest ways to lose a lot of money very quickly, because once you buy something overvalued, then you're at considerable risk as the market could drop right down to drop right down to fair value again. That's typically what happens. So our goal with ValueCharts is to create a tool that tells the market valuation, and people talk in terms of overbought or oversold, but talks in terms of market valuation at every stage of the game. So regardless of what price and time combination you have, value charts are designed to give you a description of what's happening. Okay, can you see my screen again, Thomas? Are we okay there? I finally rebooted here and looks like my indicators are finally working again. Okay, I'm going to go ahead and put up a value charts indicator here just so you can see what I'm talking about. Okay, so the difference between Bollinger Bands up here is that like John Bollinger said, it gives us a reference level for what might be kind of low prices underneath the bottom band. I'm going to go ahead and expand this a little bit so you can see this a little more clearly. So low prices below the bottom of the band and then high prices above. So Thomas, can you hear me okay, just to do a sound check?
Yeah, we can hear you.
Okay, good. So this is just a very basic tool. Really what John Bollinger's done is taken a moving average of closing price, I believe, for the center band. And if we double click on this, we can see, I think it's, see here. You know, I think my, for whatever reason, my value candlesticks are freezing me up here. So I'm going to close this desktop and see if that helps. But getting back to the, let's see if this works again here. Format, analysis technique, there we go. So right now, if you look at Bollinger Bands, we're looking at Bollinger Bands and working from the close here, a length of 20. So we're looking at a 20-day moving average and then taking 2 standard deviations above and below the moving average. Okay, so here's the moving average in white, and then the upper line is blue and the lower line is red. Now what value charts are designed to do is something actually very different and somewhat similar. I mean, from a basic standpoint, this is a very primitive overbought, and oversold, or high-low indicator, and I believe John Bollinger would tell you that. Now I think it can be useful, and I think they actually complement each other, but value charts not only says here's what's overvalued, and we describe not only overvalued, but that in different stages of degrees. We have yellow, the upper yellow portions here, and also mirroring that on the value bars up here are what we call moderately overvalued, and then when prices reach extreme points, then we can call that significantly overvalued. So we define fair value in the center is green, and moderately undervalued is bottom yellow, moderately overvalued as upper yellow here, and again the value bars are communicating the same information, the same color valuation zones as the value charts indicator below, but they are not communicating the momentum attributes. And the value charts can communicate a divergence, a value divergence. I'll see if I can find a good example of that, whereas the value bands don't do that. So right here is a good example. Notice how the British pound sold off on a 240-minute basis here, and we got down into significantly undervalued, and that was actually below the bottom band here. So he's saying this is low. We're saying that is undervalued, but that's moderately undervalued until we hit the red here, and then that becomes significantly undervalued. So when you hit these, quite often, at least even if the market's heading farther south, many times you'll see some sort of a consolidation before prices head down again. Now notice we have a lower price level here with the value bars, and we have a higher price level here on the value charts indicator. So that shows you a little bit of a divergence here, a value divergence. So it has a slight momentum quality to it, but that's not illustrated or demonstrated by the value bands, or value bars, excuse me, indicator up top. So the difference, again, just to highlight, John Bollinger is designing a simple plus or minus 2 standard deviation band to go around prices and to say this is low relatively and these are high relatively. Playing around with a while back was when you see a maybe indicator confirmation that tells you should be buying, for example, and you see the prices head below the Bollinger Bands. Let's say you're looking to buy in here. I'm going to wait for prices not only to head below the Bollinger Bands, the bottom band here, the red band. I want to see significantly undervalued prices as well, and that could be something you look for. So you'd say, okay, this price level right here meets that requirement. So you can see a bottom, very bottom red tip there. It's kind of hard to see, but it's there. You barely dip down into significantly undervalued. That may be the point that you're looking to buy. So you're not interested in significantly undervalued within the bands, but once it gets outside of the bands, then you're looking for both of these to agree with each other. So there are some interesting ways you can use these two in conjunction with each other. They're not mutual. They're not indicators that are designed to do the same thing. Value charts also is extremely complex in terms of mathematics. The newest version of value charts that we have has a auto-scaling multiplier property. That's not in TradeStation. That's actually going to be in Train, though, when we launch it this year, hopefully in the second quarter. And value charts, we've had several PhDs take a look at that and validate it essentially as an indicator that is able to adapt to changing volatility. So John Bollinger's right on the mark. Markets are experiencing changing volatility. The volatility is constantly changing, and it's important that our indicator adapt to that. And value charts uses a special unit over here called dynamic volatility units. These are not the same price units as the chart above it. Okay, these are different, and that's why what's neat about value charts is it doesn't matter whether you're plotting a British pound or I can go over here to corn, and it doesn't matter what market you end up plotting, you always have fair value between -4 and +4. So the indicator adapts. It speaks a universal valuation language, and it's okay, by the way, to buy at fair value. Sometimes that's very acceptable. All right, I don't know if I answered that question, hopefully, to what our trader was looking for, but that's my answer.
All right. The next question is from Dolores, and it says, what does the multiplier variable do inside of value charts?
Okay, good question. If you go to the format analysis techniques section here in TradeStation or NinjaTrader, and you go in fact, I'm going to pull up NinjaTrader a little bit too to talk about that platform for NinjaTrader users. But for value charts, you're going to notice that we have two parameters. We have what's called an analysis period, and this determines how short of a time frame you want for your value charts, price window or your value charts indicator. And this typically should be between 5 for a very short-term focus on valuation to 50 for a much longer-term focus on valuation. And the scaling multiplier is designed to adapt the width of your dynamic volatility units down here. So the idea is that I have 0.2 we find is a fairly universally acceptable value, but if I wanted to expand those units a lot, I could say, okay, I'm going to make this 0.3, and notice as I do that, look down here at the value charts. You see this red area down here, significantly undervalued? That's going to go away, okay, because we never quite reach it. I've expanded my units, and so fair value now is encompassing a lot more than what we designed it originally to do as being 68% of the price activity. Now it's probably, closer to 80%. So that you can adapt that. If traders want to modify that a little bit, we've given you the control to do that. In general, I think 0.2 is a nice value that seems to work fairly well across all markets. Don't worry about the decimal there. It really is nothing more than a scaling multiplier. It's nothing that you need to really worry about. But the analysis period really is something you do want to worry about. And there's two ways, just not to go off track here, two ways to adjust your value focus. You can do that by selecting shorter term price bars. So if I wanted to go very short term, I could look at, for example, a 1-minute corn chart if I wanted to go, and that's really light trading tonight, we can see, or a 15-minute corn chart, a little bit shorter term still, but that's with respect to daily. I can look at daily if I want to, a little longer term. And so I can change my value focus by selecting a shorter term or longer term bar interval. And I can also change that by changing the analysis period, anywhere from 5, which is very short term. You'll see, watch the cycles here. Watch how reactive it is at 5. You see how it's much more reactive to the, the noise in the markets. I can go all the way out to 50 if I want, and you'll see much longer term picture. See how that has a much longer term view of overvalued and undervalued cycles. And one of the neat things you can do is look at when a market is long-term undervalued, maybe the 50 bar cycle or 50 bar analysis period, and then also look at the very short term as well. And you can drill down to 120-minute or 60-minute bars in the context of this overvalued range. Now, one thing just to point out really quickly, just because a market is overvalued does not mean that you should sell it. And the reason why is because markets can encounter what we call value migration. Okay, so if the market has a compelling reason, like a drought, maybe like last summer, corn prices rocketed up, and we saw corn The crops were being damaged, or they weren't coming out to the the quantity and the quality we were expecting, and so corn had a really nice bull market there, and we saw major value migration, and you see that prices kind of stayed overvalued for a period. But in general, in the absence of that type of catalyst in the markets, it can be very helpful to look at just normal overvalued, undervalued periods, and that can be helpful to look at multiple time frames as well. All right, Thomas, next question.
From Keith, he wants to know if we can explain how to use the price action profile.
Yes. In fact, with your permission, I am going to introduce our Bloomberg application, because this really has the best price action profile indicator. We were able to actually go in and have full control over the graphic user interface here. For the most part, we had some limitations, but we were able to build out our price action profile closer to the way we wanted it, and this will help you understand how that operates within the confines of what we have in NinjaTrader and TradeStation. So let me go ahead and just launch that, and I'll show you exactly what that is. It's actually a great tool. I need to start using it more. Once I have Train online, you're going to see it a lot more on my screen. So I'm going to say close the tips down here. I'm going to expand this. Okay, and close this down. We're looking at a 60-minute chart of the Dow Jones Industrial Average, and you can see that the price action profile, okay, does two things. First of all, it validates value charts. Okay, the way it does that is when you see a statistically attractive bell curve here of the distribution of value charts bars across the dynamic volatility units. Now, this all sounds like it's complicated, but it's really not. If you took all these bars right here and stacked them up to the left-hand side of your screen, you're going to see this profile, essentially. That's what it's designed to do. Now, from a trading perspective, why do we care about the price action profile? Because it tells us the degree that a market is overvalued or undervalued. And the way it does that, I'm going to go ahead and pull out my marker here. Let's see here. I'm going to get a different color of pen. So I'm going to stand up, maybe orange. Okay, if you notice here, the green area right here lines up, that's fair value, lines up with this over here. So it's not going to be perfect. As a matter of fact, so that you understand those are correlated. So this zone correlates to that. The upper yellow, moderately overvalued, correlates to the same thing on the price action profile from our value charts price window. The upper red, which is significantly overvalued, same thing. You see all the colors correlate with each other here. And we can see now with the closing price right here, the closing value at 13,954 of the Dow Jones Industrial Average, we were moderately undervalued. This is called the value charts, or master value charts window, and that's what we call a status bar down there. But you can look over here in the price action profile window and see that we're trading at -5 value charts price level, and we trade at or below that level 6.3% of the time, or above that level 93.64% of the time. So we now have the ability to determine the degree that a market is overvalued or undervalued. So I'm going to go ahead and let's see if we can get a market that's actually trading now. Maybe pull up the continuous contract S&P 500. And we can see here, let me see if I can get maybe like a 1-minute chart. Okay, I don't know how active that's going to be. Maybe even the, what might be better is to use a currency like the euro, US dollar. That should be doing a little bit more here. Okay, so this is a 1-minute chart, and from a 1-minute perspective, we're now up here in the, I think the Bloomberg needs to reset here, but up here fairly overvalued. You can see it's moderately overvalued, and our arrow should reset here once the market trades here. But we trade at or above this level 3.1% of the time, at or below it 96.9% of the time. So we're getting fairly overvalued according to the 1-minute chart. And this is not, 1 minute is really not a great time frame to look at because you see a lot of inactivity with that, and that will skew your valuation a little bit. It's going to wait, a closing price bar. The way that some charts treat prices, if there's no activity, they just repeat the closing value. And value charts does not know that wasn't actually trading, there was no trading activity there. So A better thing to do would be to go with a slightly longer term bar interval, like 5 minutes. But you can see here we're at fair value on a 5-minute basis, and we trade above that 38.85% of the time and below that 61 point, I think it's a 1.5. Yeah, I need to get glasses here as I get older. But that's essentially how that works.
Hey, Mark, could you show it really quick in TradeStation so people can see that? I believe that's what Keith was using, is TradeStation.
Yes, absolutely. Let me, in fact, I'm going to go ahead and pull up, yeah, corn should, I'm going to see if, actually, you know what, let's look at like the US dollar yen here, see if that actually pulls up. Okay, I'm going to change that to maybe let's look at a 5-minute bar chart here. Now, inside of TradeStation or NinjaTrader, so if I calculate, we have a separate pop-up window that comes up for the price action profile. So I'm going to go ahead and insert indicator and go down to value charts price action profile, and you're going to see another window pop up here. Okay, now we're trading at fair value. You can see our bars are green over here, right? And we can see the same thing happening over here inside of our price action profile window. And I can resize this if I wanted to a little bit. This has a status bar as well that shows you. The one thing that this doesn't have, and it's not because we don't want to put it there, it's because we've exceeded the limitation of what this type of application can do, but we don't have the percentage boxes. But what we do have over here is what we call the price action profile statistics. So if I were to reach a degree, let's say trade at 4, the 4 value charts price level or over, I can look over here and see that this market and time frame combination trade at or above 14.8% of the time. Or if I reach -8, things get really undervalued. You can see down here where prices really dropped off and they got very undervalued, then that trades less than 1.56% of the time down there. Okay, so you have the same bell curve here, and the bell curve is going to be influenced by how much data you've downloaded. So if you're looking at a very short data period, the bell curve could be ugly, and that's fine. That's just means that you haven't had enough data sample, if you will, to really build out your price action profile there. But it's over here. These are the things you kind of want to get used to looking at, and you'll start to really get a feel for this over time. So there are times where I kind of know in the back of my mind what significantly undervalued is telling me. It's telling me that prices have kind of got overdone the downside. Now again, just because prices reach significantly undervalued does not mean that you want to be a buyer, okay? Because a market could have a value migration, and that's exactly what happened here. You see prices really sold off hard here on this 5-minute chart, started to stabilize down here, and then had a bounce back. Or they really rallied hard here, way up into the significantly overvalued territory, and then they started to get stabilize. And you'll notice that we were red over here, we're yellow over here, and we're green over here, and these are essentially the same price levels. So one question you may have is, how can that work? Well, think about value, how value works. Value is time at price. Okay, so for example, when I lived in Florida, people were selling condos for, these trashy condos right on the ocean for $400,000. And we thought that was just outrageous, when we first got there. But then we soon realized that, those things were actually really going up in value. So there's a massive value migration. And a friend of mine bought one. I think he flipped it within like just a few months and made $100,000 on it. That's back when real estate was going crazy. And eventually, a lot of those lots ended up going for over $1 million. So that's how that can work. But the idea is after the market really kind of settled down and started trading at the same price in real estate, the idea was that, okay, $1 million back then just seemed crazy. Well, you know what? We started getting used to it. It still seemed overvalued for a while, and then eventually we now look at it, and it's traded at $1 million for so long for that seaside property. We now look at it as fair because that price has been a transacted, changed hands several times at the same price, and now the market has kind of accepted it. So time at price equals value. That's how value is formed. Thomas?
All right, the next question is from James. He wants to know what our timeline is as to when we're going to be available on Sierra Charts.
Sierra Charts. Okay. That's one of the things we have on our to-do list, and that's a very good question. That is hopefully something that we can get to very quickly here. We've actually started developing for other platforms. We're very, very close to being done with the eSignal, and we're looking at Sierra charts and MT4 and 5 next. So that that is something we're doing on the side. Our programmers during the day are working frantically on the train platform, and then after hours, as we can encourage them to do so. These guys are killing themselves already, but if they can find time to do that, that's going to be something that will be done, I hope, within the next couple of weeks. And I appreciate your patience. We were hoping to get it done sooner than that, but we just ran into challenges with the signal feed in January, and we obviously want to make sure that our website is functioning as well. So we spent a lot of time on that as well. So the long and the short of it is, I hope, and our head of development is actually on the call tonight. He's probably going to kick me for saying this, but I hope we can actually get that done with Sierra charts in the first quarter. So I hope we can do that. That's what my goal is. In fact, if you are interested in our charting package for Sierra charts, shoot us an email if you don't mind, and just ping us to say, if you don't mind, email us and ask for Thomas. Say, Thomas, do you mind emailing me when that's done? And Thomas or myself will keep a control list, and we will shoot you an email once that's done.
All right, next question is from Lee. She wants to know, can you discuss the differences between wide and deep histograms on the MQ momentum indicator, and what outcomes are associated with each?
Okay, so MQ momentum, she's wanting to know about wide and I assume higher magnitude or lower magnitude histograms. Is that how you'd read that, Thomas?
Yeah, what's the difference between a very large move where the market has a lot of momentum in one direction or another, or one where it's just a very slow moving trending market where the histogram is extremely wide?
Okay. If I understand your question, excuse me, if you see a value migration like right here, we saw it's a nice sell-off here. Okay, so prices are trending down, they're moving down here on gold on a 240-minute basis. It's a pretty dramatic sell-off. We're seeing prices go from right around, call it 1690, all the way down to a low of, call it 1660. Okay. And when you see that happening, you're seeing a value migration. You're going to see that show up in the MQ. In fact, I'm going to go ahead and just remove these other indicators here so we can get a better focus on that. You're going to see some more, a higher magnitude reading on your histograms here, and you'll see that your histogram cluster remains red for longer because you're seeing a value migration. If you're a seller, that's exactly what you want to see. Okay, now notice once you go back into consolidation, we're not getting those really long, deep histogram clusters, if you will, or cyclical ups and downs. It's more kind of chopping around. In fact, if I go to 60-minute here, you're going to see even more of that. So during this slow time right here, just notice it's just kind of chopping around a little bit. We're not getting high momentum or strong momentum in either the up or the down direction. And then we finally broke down where we saw prices sell off. This is a great sell signal, by the way, breaking that trend line we've been tracking. And prices sold off here, and then you see a larger momentum histogram here to the downside, and then as you see kind of prices rebound here, maybe $10 an ounce, and they stay up here. You see the positive histograms there. If you see the histogram values exceed the 25 level on the upside or downside, let's see if we can find an example of that. Right here on the downside, right there, I would definitely take note of that. Or right here on the upside. Okay, that's saying you had a really strong histogram up move. It doesn't mean you want to sell it or fade it, okay? But it means you may want to start watching out for overvalued conditions. And right here, this is the type of thing Thomas is going to point out in the trade room. He's going to say, look at this massive weakening here of the lower histogram value, and the prices are just kind of weakening the upside here, and it's overvalued. So he might take a short signal under those conditions. And then right here on the long side, we see the prices really sell off here, and then we see that higher low here in the histogram, and that's the type of thing that Thomas will look to often buy at. I don't know, Lee, if I answered your question on that, but if that didn't, do you mind just letting me know, and I can go over that. So depending on the value migration and whether we're in a trending or a momentum, high momentum state, you're going to see more or fewer of these histogram price bars. Okay, so that just is really measuring the strength of momentum. And by the way, as traders, Thomas will probably tell you the same thing. I'm always looking to have 3 things up in my trading window. regardless, I mean, these are the things, these are the non-negotiables. I have to know about value, okay, whether it's the value bars up here or value charts window down below. I have to know about momentum, and I have to know about price. And the nice thing about value bars is that's a two-in-one deal there. I see price, which I'm interested in seeing. I see value, which overlays the colored value bars on top of price, and I see momentum. All right, Thomas, ready? Shoot me another one here.
Yeah, next question is, do we have a timeline for signal feed and when it's going to be available on Apple products?
On Apple, I'm sorry, Apple products?
Meaning, when is signal feed going to work on a Mac?
Like iPad, okay, on a Mac. Brad, if you're still around, I don't know if you want to comment on that. I was under the impression that you could actually use a PC compatibility software for that to get that to work. But really, I'm speaking out of school a little bit here. I don't know if Brad's still with us, but if I'm thinking that that there's some way to use a compatibility software to get that to work. If I'm wrong about that and you've already tried that, then we'll take a look at that, because we do actually have a Mac in the office, and we can see if there's a way that we can get that to work. But keep in mind that the train platform is what we're working on now, and okay, I see what you're saying, parallels but slow speed. John, thanks for your comment there, by the way. Yeah, so let me take a look at that, and I'll see if we can get you a formal answer, especially for everybody who's in the live trade room. Okay, Kimberly, thanks for your answer there. It's like an Adobe Flash compatibility. Let me take a look at that and ask Brad for the answer there. So Thomas, make a note of that.
Brad said once train is completed, he said once train is completed, it'll have signal feed integration, or they can use Windows compatibility. We'll also support HTML5 version after train is done.
Okay, so James, to answer your question, I think it was James who asked that. If we can get train is near. I mean, we're hoping to have something out in train in the next couple of months. So I know it seems like a while away, but let me see if there's a way to find a compatibility solution for you with signal feed, because I get why you want to have that. But if there are performance issues there, we'll see if we can figure out what's going on, or try to find an optimal recommendation at least. But with HTML5 accessibility and train, you're going to have that. That's going to be a beautiful thing. So that's going to clear up a lot of your issues there. Okay, Kimberly, thanks for your comment there. It works for you sometimes, but not always. I'll see if we can take a look at that and maybe just have a quick conference with the programmers to see if there's maybe a way or a specific type of software that might be optimal for that. But certainly once train comes out with HTML5, we will have that. And I appreciate your patience with that if for some reason it doesn't work to your satisfaction on the compatibility. But let us look at that and see if we can come up with a reasonable solution there.
All right,
Thomas. Yeah.
Center wants to know, what are some of the line in the sand rules that you live and die by no matter what occurs with your trade?
Wow, that's a great question. One of the things I'd say is I would make sure that your risk management is really well thought out. Okay, and what I mean by that is let me see if I can even show you something here. Radar screen, believe it or not, I've been having that program has been taking years off of my life. I've been trying to figure out a way for it to give me some information here on that. But we wrote a program. This is a hedge fund caliber volatility adjustment program. Let me see if I can see here. I'm going to see if I can insert an indicator that is designed to show you how many contracts you may want to trade. You know what? I think I need to build that out for. Okay, let me apply that to the chart. I know it works in the chart. But what I would say is this: you want to have a way of understanding what you're risking. And unfortunately, with contract sizes, different markets represent a very different size contract. Okay, so I've got gold up here right now. I'm going to go ahead and pull up a daily chart here, and I'm going to insert an indicator that is designed to show me how many contracts that I may want to trade. So let me pull this up here. I think this is going to do it right here. Hopefully it doesn't mess anything up. Okay, let me try a different one here. I haven't used this actually on this computer. So just a second here. Format, analysis technique. Let me take that off of there and try a different one. There's actually several of those that might show up. There we go. Let's try this one. Okay. The idea of this indicator right here, now you can change your portfolio size. This is, let's say this is really these numbers to some extent are arbitrary, but let's say I want to look at smaller account size here, or we'll say $10,000. Okay, and this is, again, this is not a $10,000 account. It's just you have to have some sort of reference level. So what I'm doing, what I typically do is I have two different measures in my ATR risk management. I'm answering your question, and I'll try to be quick here, Sinter, about answering your question. But you'll notice that one of these lines is at 4 and one's at 5. Now, I take the lower of these two. This says I can trade 4 gold with this account size. Now, this is a larger account. This is not a $5,000 or $10,000 account. If you're smaller like that, then trade 1 lots, if that's even appropriate. Okay, now let me go over to silver here, and you're going to see that change. Okay, now silver, we're down to 3, okay, and 2 on the downside. You'll notice the blue, you can't even see it here, but 2 is the value for silver. If I go over here to coffee, that is going to say I can trade 5 coffee with a given volatility. Let me see if I can find, or corn. I bet it trades like 10 corn, 12 corn. Okay, you notice how it's different. The answer is different here. Now, the reason why I have 2 of these is because the red line is a lot more adaptive than the blue. The blue line's a longer-term volatility adjustment indicator. The red line's a lot shorter term. And I take the lesser of those 2. Okay, I'd be more conservative. So my first recommendation is figure out how you can normalize your positions. Okay, as much as you can. Now with small accounts, it's more challenging. But if you're trading 1 coffee, okay, in your account, and here we have 5 coffee, then you don't want to trade 1 corn. Okay, because corn's literally coffee is maybe 2.5 times at least the size of corn, if not larger. Okay, so understand the differences there between the size of the contracts and the volatility. The S&P E-minis, for example, we probably get a lot of those. We have 11, and you can kind of see how that works. Euro currency, probably just like 2 or 3, 8 actually. That's surprising. Maybe because the volatility has not been that great recently. So that's rule number 1, is to do that. Rule number 2 for me is to use stops. Okay, depending on what kind of trading you're doing. Now, if you're trading a rule-based strategy, then I would say that as long as the rule-based strategy has some way to manage your risk, it's going to get you out if you're wrong, and you're satisfied with that, then you can use that. And sometimes that's not going to always include stops. Okay, there may be a moving average crossover, and it doesn't have a stop component. Now you're taking a little bit of a risk there, because if you have a big down bar that doesn't register a close, and I'll see if I can find a situation where that's the case, in your chart, like right here, you can see that the market moved, this is the daily, it moved almost $15 an ounce here in 1 bar. Okay, now obviously you'd probably be looking more at intraday activity, but make sure that you can handle the risk of a large bar trigger, okay, with your strategy. But if you have a strategy, you're comfortable with that, then go, I would say you can look at the natural ebb and flow of the strategy. If you're trading from a discretionary standpoint, and this is what Thomas does in the trading room, just looking for good opportunities and using his knowledge and experience, then I would always recommend using stops. Now, here's the trick with that. Thomas, you can chime in here. Literally, there's a probability characteristic of this, and there's no right answer per se. Thomas has been stopped out of a lot of great trades just by a tick or two. There's been a string of trades that have just kind of knocked him off, and they've been good trades. So we've been talking about where do you put your stop? Should I give more room? But if I do that and I'm wrong, then I'm giving up more money there. So there's a little bit of art and science involved with that. But if you're buying undervalued in certain circumstances, then theoretically you should be able to put your stop closer and risk less. Okay, that's a bottom bar portion here. If you wait for the market to shoot way up and you're buying overvalued, you need to risk a lot more, possibly, to let the market really start going in the direction that you believe it's going to go in, if you're even right about the ultimate move. So to review again, you want to make sure your position sizing is accurate, your money management, that's really important. That will destroy your probability model if that's not really well attended to. You want to make sure that you use stops or some sort of risk management with your trading. Okay, that's really important. The other thing is I would really spend time studying the characteristics of the markets that you're going to trade. Okay, what do I mean by that? Well, if you look over here at lumber, for example, or coffee, let's pull coffee up. Notice that in coffee, there's usually a pretty wide bid-ask here on a 1 minute basis. I mean, usually it's even 20 ticks sometimes, 15 ticks. It's not one tick. Okay, the euro currency or the bonds, for example, is going to have a very tight bid-ask. Okay, understand how that works. It's one tick up or down here. Okay, that's a very liquid market, and then 10-year notes and 5-year notes are even more liquid. Eurodollar is insanely liquid. Okay, so those have a very tight bid-ask. But you get down here to coffee or platinum is another one, your bid-ask is going to be much wider. So understand the characteristics and the liquidity of the markets that you're trading. Markets that are less liquid are much more easily manipulated. Okay, understand that. So people, it's a lot easier for smaller traders to run your stops if they want to. So make sure you understand the markets that you're trading. And then the other thing is I would really make sure you understand your strategy. Is your strategy one that's going to be profitable longer term? And if your strategy involves your best judgment on how to trade, be careful, okay? Because we are all vulnerable to greed and fear. We're all vulnerable to, to following our emotions, and we're going to lose money if we do that. Okay, when I trade in my emotions, I actually track myself a little bit. I can't make money because my emotions are chasing market. I'm getting greedy or fearful, and almost like clockwork, I'm buying overvalued or selling undervalued. But if I discipline myself and I ask myself, is this valuation attractive, and we're not experiencing value migration, but just a correction here, I'm going to buy undervalued or moderately undervalued or significantly undervalued, and I'm right that it's nothing more than a correction. Those are the types of trades that I look for. I use a stop every time. If I get stopped out, a lot of times I get right back in if I feel it's still a good trade. So and there again, you have to have rules there as well. But I would also limit the amount of money you risk every day. You don't want to be in a situation where you have a blow up. And I've seen this happen. When I worked on the floor of the Chicago Board of Trade in the late 80s, and I saw a guy who'd been there for years, and he just lost it. I mean, he just started trying to dig his way out, and he lost more money. He bowed up, and he broke his risk management rules, money management rules, and by the end of the day, he was done. I mean, it was really kind of a sad thing to watch. The guy he was over, and it's really unfortunate that that happened. So those are a few things, but understand trading profitably is simple, but it's not easy. Okay, so think about it. It's a simple concept. Prices can only go one of two ways, either up or down, but it's not easy. And I'll tell you what, there are forces in the market that are working overtime to try to take advantage of your and my emotions. They want us to trade emotionally, and they're making boatloads of money when we do. So make sure you understand how your emotions can work against you. That is a very long-winded answer. I hope I gave you what you're looking for there. But so use stops, make sure you understand position sizing, money management, study your trading strategy, make sure it's proven, to have an upward bias or profitability over time, and then always be a student of the game. I've been studying the markets. I'm one of the biggest price nerds you'll ever come across, and I feel like I've got more to learn than I know. So go out there and maintain humility and just always be a student of the game, and you're going to find that you're going to enjoy it a lot more. And you can always typically I find that I can always take gold nuggets away from talking to other traders, newer traders even, as well as older traders. They just tend to observe different things. John, I'm gonna talk about you for a minute. John from California went to Thomas and say, hey, Thomas, I noticed something that you were doing, with a tendency you have in the trading room. It was great. I loved it. And Thomas loved it too. It was just kind of a neat thing. So we're always willing to or looking to learn things, how we can do things better or learn more about ourselves. It's always a sharpening the sword type deal. That's a very long-winded answer, and I apologize for that. I can be very long-winded.
All right. The next question we have is from Robert. He says, when viewing charts, how do you prioritize the MQ indicators when looking for an entry or exit signal, and which MQ indicator provides the most reliable signal in combination with the various time periods, i.e. which indicator works best or is most reliable with what time period?
I may have to defer that to Thomas because he's the guy in the trenches every day in the live trading room. Thomas, do you have any ideas or thoughts on that?
Absolutely. The first indicator I look at every time is value. I want to know what the value is because I try to never enter a long position in an overvalued market or a short position in an undervalued market. The second thing I'll look at is the momentum. And I believe what you're talking about is divergences. When we trade a lot of divergences in the trading room, sometimes you'll get a divergence across multiple indicators, but the first one that I'll look at for a divergence is always momentum, because that seems to be the most accurate. When the momentum starts dying off, oftentimes the market will rally or fall accordingly.
Yes, I've got value here with value charts down here. I have momentum with the MQ momentum. Anything else, Thomas, that you like to watch? There's a lot of, each indicator will tell you a different thing. So it's not always the same ones we look at. But Thomas, what else would you say?
Well, you can continue to drill down and add more filters. And honestly, the more filters that you add and the more criteria that the trade meets, the higher your chances are of having a successful, profitable trade. So you can do things such as look at the regression line for the trend and trade in the direction of the trend. You can also drill down and look at your market strength and see what the average rally or sell-off is, and then buy or sell in that direction.
Okay, market strength is, I'll go ahead and insert that. That is right here. Where's that? Here we go.
Yeah, we were talking about this in the webinar last night as well, and we traded off it today with the, I believe it was wheat. It was either wheat or corn that we were looking at. And we saw that the average sell-off was right where we were, so we went ahead and took the longs. And we didn't really have to risk much because technically speaking, the market wouldn't have or shouldn't trade any further than where it did, or go down further than where it did.
What market was that? Was that corn?
That was corn.
Okay, let's see. It's interesting how there's a consistency almost. What time frame was that, Thomas? Do you recall?
You can see it right there.
Okay, so right here, just kind of like the consistency of the sell-offs almost.
Yeah, if you look at the average, if you condense it a little bit more, you look at the average sell-off, there's a lot of highs basically right at that same area where we were right before it rallied.
Yeah, that's true. Like all the way back in here. It's just one of those mysteries out there, or patterns that you end up seeing, but that's interesting. And then sometimes there'll be multiple levels. So right here you can see a number of tops. And what's interesting is these were back in early February. Okay, so those are three that peaked out right around the 10-cent level. And then literally here we are in later in February, we have one that peaks out very close to that as well. So there's that rhythm the markets have sometimes that can be somewhat predictable.
So it really just depends on which indicators you're looking at, what type of trade you're placing. If you're placing a divergence trade, I normally go for the momentum, then the cycle finder, then the trend index. But always the number one thing I look at, no matter what trade I'm placing, is the value level, just because it helps you filter out so many bad trades. Yeah,
no doubt about it. See, trend index, I'm going to put that up there. And another thing, just to point this out, is you'll see some trading screens out there that the traders have with a jillion things on them. For me personally, I just tend to rotate them out sometimes. I can get if my screen gets too cluttery, it's hard for me to to really focus on some things. But this isn't too terribly bad right here. But you'll see, that's why you'll see sometimes we'll have different MQ indicators up there just to give us a slightly different look at the market. So thank you, Thomas.
Yep. All right, the next question we have is from Zen, and they want to know, for someone who is only able to actively look at the markets in the evening, what methodology would we recommend? I understand.
Yeah.
Sorry, I understand looking for signals on the 60-minute chart, etc., and stops beneath the low's highs, but how can you drill down on these time frames when the market is closed?
Well, I would say this, if you're only able to look in the evenings, I might suggest a longer time frame. So I might suggest you look at, and I can't advise you personally, by the way, so I'm saying in general, what I would suggest is that for a person who can't afford to look at the markets during the day, when I say can't afford to do it from a time perspective, you've got time commitments elsewhere, I would say that a swing trading could be something you ought to look at. And Thomas and I were talking about today with this beautiful yellow-tip doji here in soybeans, but there's some other conflicting signals there where we just need to watch that. But that could be a good trading signal right there. But swing trading can be a possible strategy that you can use. And the idea there is to, in fact, the stock market, S&P 500, had some really interesting swing trading opportunities not too long ago. But that may be something you want to look at a little bit. I don't think you can afford to look at 60-minute charts per se. If you want to look at, unfortunately, you know, the thing about that I've noticed is that the Asian period from maybe 6 or 5 Eastern to almost midnight, that tends to be the lowest volatility period many times. So I don't know that I'd trade. That's what I kind of refer to as a grinder. So if you're trading 1-hour charts or at night, you can see even recently tonight we're not seeing a ton of volatility out there. I mean, markets are just they're just not really doing much, and a lot of times those are very hard conditions to trade in, because we don't know whether something is just kind of temporarily being pushed one direction, or if it's somebody's getting out of a big order, and once they do it, they're done, and then the price will come right back down. So that's a little harder period to trade. I find that maybe starting at midnight or even 2 or 3 in the morning to all the way through the close of U.S. are the easiest hours to trade, because you have more volatility. But I take a look at daily and or possibly even weekly charts as well, and that's going to elevate your risk a little bit, obviously maybe a lot with respect to stops, but you can kind of get a feel in your mind for what a market's doing. And if a market price reaches down to a certain level, I believe you can actually program TradeStation to send you an email. So, or NinjaTrader as well, or multi-charts or Sierra charts. So there's options there, you know, to if it hits a little level that you're thinking that might be undervalued or a short-term buying opportunity, you can pull up a chart at that point. Now, the second thing I'll tell you is we are designing Train to help with that. Okay, so we understand that you've got time commitments elsewhere. That's why I'm very excited about Train, because I can tell you I have a lot of other things going on outside of just sitting in front of the screens and trading. So that's challenging, and we get it. We understand how that works. So Train is going to have a lot of really unique features on it that I think that I can't wait to use personally, because I have a lot of other time commitments outside of watching the markets. All right, Thomas, you're up.
Sorry about that. The next question we have is, can you illustrate a trade based on divergence and one based on a candlestick reversal, and how are both related to value charts?
Yes, candlestick reversal, and we've been looking at a lot of those. Let me see if I can pull that up here. We had that. Yeah, let me see if I can apply the candlestick chart here to the window. So insert indicator. We just actually have wrapped up one of our candlestick strategies here. So let me see if I can pull up maybe a daily chart here. You always want to kind of look at the context of candlestick signals. Okay, so when you don't just take them, you don't want to take them blindly. You want to look at the context. In fact, let me see if I can pull up figure out if we can find a decent one here. And sometimes, there's obviously going to be some very good ones as well. That sometimes Thomas will tell you, look, if the trend's down and you see these red dots above here, sometimes the ones even without a large degree of separation, or maybe right on the ADMA, are going to be okay. Like the yellow tip doji here. It says green doji because I need to have my candlestick and my value bars matching. My value bars are 5, and I will change my candlestick to 5 as well, and you'll see that actually matches up. So,
hey Mark, you also need to remove the doji and hammer indicator, because you have 3 different candlestick indicators on there right now.
That would probably help, wouldn't it? Yes, thank you.
Yeah, just use the last.
There we go. So here's what we watch out for. Right here is a divergence, and I think that's probably not a bad signal right there. That's one I probably would have taken. Now, I don't, this ends up being a signal where we would have lost out here. Not risking a lot here. That's going against the trend, but I see a bullish divergence forming there. This is in the direction of the trends. You see some of these other indicators, like this yellow hat doji. That worked out really nicely, and depending on where you want to take your profits there, a bullish divergence. Let me see if I can find an example of that. Again, here's the direction of the trend. You have a beautiful yellow jacket doji right there. So you're selling at the open of the next bar. You hit the ADMA. You move your stop down to break even, and then you can even undervalued in 1 bar. Boom, just nailed that one. That's a beautiful example. Right here, this is.
One thing I want to point out.
Yeah, go ahead.
Sorry, I was going to say, one thing I want to point out is that this indicator that we're showing, although it's not going to be for sale because we can't give everything away, but we will make it available on signal feed, so you can get alerts by a signal feed whenever these markets have reversal patterns like this, and you can get it on multiple time frames all the way down to a 30-minute chart, so you can follow 30 or 40 markets at once without having to necessarily be sitting right in front of your computer screen looking at 30 charts at once. It's going to be very, very neat once we have it up.
Yeah, in
We're
fact, I
currently
need to,
testing that.
yeah, make my minimum tick to 0.25. That's going to weed some of these out. That's one thing I didn't, you got to modify that for every market. You can see that weeds out a lot of the bad ones. So we have that, obviously that is a beautiful one. We have a, this isn't a terrible one right here, but I don't see any divergence there to compel me. I see almost strengthening downside there. So that may be one that we would probably pass on just because there's not a compelling reason. Right here, we're in the direction of a trend. Okay, and we really shot up and we're trading, consolidating here. Next expected move in the direction of the trend, but counter trend without a bullish divergence is something that I would recommend passing on. See if we can find one where there's here's a nice one. Look at this bearish divergence right here. Okay, so you notice what's happening right here with your momentum indicator. You're down here, or this is your first reference, okay? You have a surge up and very high. You're over the 25 level with the MQ momentum. Your next surge higher, you think about the market unfolds in waves. So price discovery is kind of a wave process. You have a lower reading there, even though you have higher prices. And this third one here, you have even lower momentum. So you have a double bullish divergence here of prices. See how this final top right here has surpassed the previous top. And then you end up getting a yellow jacket doji. Now, what Thomas teaches in this class is that I'm not going to put my stop right above this doji. I'm going to find a recent support or resistance level that's even higher. So that natural choice would be the previous bar right here, and the high of that is 744.5, and we don't reach that, I don't believe, in this bar. It touches it, but it doesn't exceed that. So my stop would be a little bit above that, maybe a tick or more. In that case, you escaped it just a hair, and then boom, you're right in business. Okay, now this is a red tip doji, not a bad signal, but there again, the problem with that is in the direction of the trend. Okay, so that could conceivably be one you take. The problem with that is you don't have the divergence or momentum really backing you on that one. So that is probably not as good even as this counter trend one, because you've got momentum and divergence working in your favor. So I think that in general, that's what Thomas and I try to look for, is the momentum and divergence mostly. And sometimes with trend trading, a lot of times we'll look for the overvalued scenarios, and maybe just take advantage of a market getting emotional and just poking up into to moderately overvalue these price points, and then just selling those in the direction of the trend. Thomas, did I answer that, do you think, or do we need to elaborate on that?
Well, I think he was asking more along the lines of what's a divergence? Like, why would you go long off of a divergence compared to why would you go long off of a reversal? So you explained a little bit about what the reversal is. It's one of the higher probability candlestick patterns based off of candlestick psychology that says the market is going to be turning. But with a divergence, what you're looking for, you don't necessarily have to have a candlestick reversal. You can just have a great bullish or bearish divergence, which Mark showed a couple examples of that already, which is just where prices and indicators lose sync.
Yeah, right here is a great selling example. I mean, just ignore the even ignoring the candlestick pattern right there, which I think is a good pattern, but you're not even risking a lot with that one. But this overall scenario right here is a beautiful divergence. You see a lower histogram reading on your momentum, and you see higher prices. Now, in general, what I like to watch out for is, notice the high right here is at 726 3/4. Okay, so if I took a line and put it right there, the market loves to run highs and lows because it knows there's a bunch of stops there. So as soon as we see it run that high, I'm not done with this trade. Even if I traded that candlestick pattern, I'm now watching. Okay, what is this market doing? We ran the stops. Is there a continuation? Is there more buying coming in the market, or did they just run the stops? See, I have much weaker momentum down here, so it's got my interest. This is the area right here for divergence that I'm looking to sell. Okay, and especially I would recommend being patient enough to see if they end up taking out the highs or lows. Here's another beautiful one right here, beautiful. If you in fact, if we relaxed our candlestick standards a little bit here, you notice you took out the previous high or low right here. You have a strong downside momentum, much weaker. You can't even really register negative here. And then you have the doji, a really nice yellow tip doji right there. And so you took out the old lows right there, and we couldn't do anything else. So that's a nice one as well, potentially for a long trade there.
All right. Next question is, what are our favorite time frames for trading? And I can say for me personally, almost every single time frame, because I'll look for, if you're in the trading room, you'll see me look for a longer term picture, meaning I'll look for an hourly, and then I'll drill down to a 1 or 2 minute chart to place my trade. Same goes, I look at a daily chart, so I'll have an idea, okay, I believe this market could be heading higher based off the daily, but then I'll go down, drill down to an hourly, and then I'll drill down even further to a 1 or 2 minute and trade off of a 1 or 2 minute, so I can risk $200 or $300 a contract and still catch a big daily move without having to risk a daily stop loss.
Yeah, well said there. And I'm like Thomas. I don't have a favorite time frame. It's almost what time frame is working. So it's interesting how, like for momentum purposes, Thomas and I will look at, for crude oil, I look at 2 minute, 2 minute charts a lot of times when the market's really moving. They can be interesting. Now obviously we're in the lull doldrum period, so we're not seeing a lot. In fact, yeah, we're going to be rolling to April crude here pretty soon. But when we're moving, and a 2 minute can be a really nice period to trade. I wouldn't trade that though on a currency. I'd never trade 2 minutes. It's more 15 maybe to 30 minutes on that. So find out what's working with a market, and you want to be as reactive as possible, but there's a lot of noise in the market. So figure out what time frame seems to be broadcasting noise, and that changes from market to market. But I like to look at the longer term time frames to create an outlook, and then drill down to shorter term time frames to fine tune a signal and get value, what I call value convergence, where you see overvalued long term, overvalued short term. And when you can get those to line up, then a lot of times you can reduce your risk. And I realize we're going over a hair here. We'll have to wrap it up here, but we're gonna have this again pretty soon. Why don't we take another question or two, Thomas, if you don't mind, and I'll try to hurry on these so we can make sure we address most, if not all, the questions here.
All right, no problem. Another one from Lee is there any way to know if a breakout will come back to retest the trend line?
You know what? There's no way to know that in advance. Some markets have a tendency to do that. Gold sometimes will do that to the upside, but not always. I mean, it's kind of strange. If you see government intervention like a QE3 intervention, sometimes that's enough of a value migration where you're not going to get that. So sometimes you'll see that though. So it's more of a situation where if the opportunity presents itself, then you want to analyze the markets. Like Thomas and I were talking about earlier before the session, the Australian dollar right here, and wondering if that's a retest of the trend line on the short side. So Thomas felt like that could be, and he may be right there. So that's a little bit of a line in the sand there with that trend line. Time will tell, obviously, if that happens, but that's a situation where the opportunity kind of presented itself. He's watching the trend line there and trading from that standpoint. The risk of the situation is that it may not. And if you're really wanting to get in the market, then there's a little bit of a judgment call you want to use there. But I would say at minimum, if you can, try to get in a market at on the right side of value. If you don't, then that's could cost you longer term with your trading.
Next question is, what steps do we employ to avoid paralysis of analysis, meaning we have too many requirements to meet for a trade to be executed, and if you can't meet all those requirements?
Yeah, over-analysis paralysis. You know what? Just remember, trading is simple. A market can only go two ways. Don't overcomplicate these things. Some of the best traders out there that were working on the floor of the Board of Trade didn't even have high school degrees. I mean, they were out there and they just were watching the markets and observing. They understood that it can only go two ways. Trading takes courage. It takes courage to stay in there. It takes perseverance. It takes patience and discipline. And it doesn't matter really what your education is, funny enough. In fact, sometimes if you're not careful, your education can work against you a little bit, because people who tend to excel in school and tend to be perfectionists, and you're not going to do that with the markets. Okay, it's very difficult to do. You may frustrate yourself with that because it's not a well orchestrated plan. It's more like war. It can be messy. It can be, things go wrong, and you just have to be able to to continue going forward. And think of it in probabilities. It's a game of probabilities. You want the odds in your favor either with a larger win-to-loss ratio, or you want a higher probability winning percentage. And that's the name of it. And watch your slippage and watch your commission costs. Okay, every time you pull a trigger, you're paying your broker. It makes him happy, but that's not your goal. Your goal is to make yourself happy and make money over time. So I'd say patience and discipline is a huge part of this game.
To answer John's question, where will this webinar be available and how long before it is available? We will try to get up there in a week, within the week. You can find a list of previously recorded webinars on our YouTube page, or you can just go to valuecharts.com/events. At the bottom of the list it says click here to view previous webinars, and that'll take you right to where all those recordings are.
Hey Thomas, are you short the Australian dollar? Or are you out of it?
I'm out of it.
Okay. Okay. I'm sorry. Go ahead. I didn't mean to interrupt.
We have another question from Lee.
Okay.
When do you use the larger momentum numbers, i.e. 50 or 30? I think she's talking about the smoothing.
Oh, that's interesting. What I like to do is sometimes if you go with a longer time frame here, I sometimes can even go as far as at 100, but like 50, 38, I just like to look for different changes in supply and demand. Okay, so let me see if I can yeah, it's not showing. Oh yeah, you know what? Let me change change this to maybe 12. If you have longer time frames, change your signal line to a longer time frame as well. That'll give you a little more of a larger histogram values. What I'm looking for is right here. Notice how we have a strong upsurge here in the histogram, and then prices achieve a new high here. Notice right here where my box is, we're hitting new highs. Okay. Now notice what's happening with my histogram value. It's way below. Okay, so as soon as you hit moderately overvalued while you're over at new highs and your momentum's just not voting in the same direction, not agreeing with you, that can be a huge red flag. So that's the type of thing I'm watching out for with a market. In fact, a lot of times even drilling down, it's more evident sometimes in the intraday charts. In fact, Thomas, that would almost argue the case for what you're seeing now with the Australian dollar. So I don't know if this will end up being a sell signal or not, but we're seeing lower momentum here, right, and a higher, moderately overvalued. So that's maybe a pretty good shorting opportunity there.
Actually, I just got back in at short again, just so you know.
Okay, you couldn't resist. Where is it? So we're at 103.34. The high is at 45. Okay, so you could risk maybe $100 and something a contract.
Yeah, you could also potentially try. You have your trend line drawn a little bit different than I do on my daily.
Okay.
But on my daily, it's only about 5 ticks away from intersecting that trend line. It'll intersect it right at about 1.035.
And well, that's interesting. Well, here's another thing, Lee, just to answer your question. Notice what's happening here. Sometimes I like to compress my bar spacing just because it gives you a different picture. Now notice down here what's happening, okay? Your momentum's much higher here. So your selling strength is weakening. And then you have right here, I don't know if you can see it on this chart, this is a beautiful yellow jacket doji right there. So that is the type of thing where you see momentum's on my side, and I've got a beautiful yellow jacket doji here, degree of separation from the ADMA. I mean, sometimes those are your nice signals, and you might be able to even shoot for a value range trade there. So you get out as soon as you hit moderately overvalued. So hit your ADMA, you've got break-even situation there, and then once you hit overvalued, you're out. Keep in mind, in this case, you're going against the trend. But that's the type of thing I look for. I like to bunch up my charts here. Again, look at this right here. Much lower value in the momentum, and you have a lower peak here. That's fine, but you have a weakening here. So this could be, the beginning of a selling campaign as well. Higher value here. Notice how your higher histogram bar is there, then over here, and you eclipse those lows. So new lows right there. Notice how those are the lows for a while. So just try that, experiment with that, and you can even use. I'm using 50 and 38 right now. Sometimes I use like 150. So play around with that. You want insight. You want to see if there's a way to detect weakening or strengthening of supply and demand. That's your goal. Right here is beautiful. Look at that. Even though we're down here in the red, that's a lower red value here, even though you have a lower price value. So strengthening on the downside compared to the previous histogram, but you have lower prices.
All right. Another question is, how do we know when to buy or sell at market and when to use limit orders? For
Thomas,
me personally,
yeah.
I very rarely use limit orders. 90% of the time I'll use a market order. If I'm using a limit order, it's because I'm looking at an extremely obvious support or resistance level, and I'll say, okay, I'll get right in on that support or resistance, and I'll probably put a tick or two above that support.
Interesting.
So, yeah, very rarely do I use limit orders, though. But we've actually been fortunate enough a couple of times in the trading room to nail exact bottoms and highs with limit orders, literally down to the tick. Found some support or resistance, we put a limit order in, and the market never looked back after hitting the limit order. So that has happened.
Was that in coffee? You did that the other day? You nailed the limit
well,
coffee?
we didn't use a limit order in coffee. We didn't use a
Okay.
limit order in coffee, but we were up quite a bit in coffee. I mean, we were in a tick off the low.
Yeah, yeah. Interesting. Well, that sounds good. All right, any more questions? Well, now keep in mind, we're going to have this every now and then, this type of event where you can just ask all the questions you want. You know, if you're not, I think many of you are in the live trading room, but if you're not in there, I would encourage you to join us. And we're always going to be looking for new, bigger, and better ways to trade the markets. We're very excited about what's happening with Train. We're like a kid in a candy shop with that, because we're traders at heart, and we have run into constraints with a lot of the tools and the platforms that are on the market, and this is a situation where we can create anything we can imagine. So that's what Train represents. We're trying to create the exact tools that we would want to have laid out in the exact way that we would want them. And that's not to say anything negative about TradeStation or NinjaTrader or anything else, because those are different platforms. Those are still very, very useful. So even with Train, I'm still going to have a NinjaTrader, Ninja trading platform or TradeStation platform to do some hardcore number crunching and things like that. Next question. Any more questions?
We have one more question, and that is, well, actually, I guess there's two questions. What is Train, and what trade opportunities are we seeing right now?
Okay, let's see here. Let's see if I just, yeah. I am seeing, the question was, what is Train? And what trade opportunities are we seeing right now? Well, I would say Train is a trader resource and information network. It's a charting and trading platform that is going to have a lot of very powerful tools for you to analyze the markets, and a lot of powerful tools for us to communicate what we're seeing in the markets, if you want to hear that, and others as well. So it's really a neat tool. It's going to be you're going to have a chance to visit and chat with people who are looking at the same markets that you have, that you're looking at. It's going to be a way for you to track the trading signals of others, including myself or Thomas, and see if you want to take trades or look at setups that we're looking at. It's going to be a way. We've got some proprietary ways of configuring it that we haven't shared yet, and we can't share that right now until we launch it. But it's going to be a situation where we are going to basically have different ways of entering orders that are a little bit unique, that we think are going to make a big difference. So that's in a nutshell. It's very neat. Stay tuned for that. I think everybody's going to love that. We had a conference call with a trader, a guy who owns a number of retail operations throughout Europe, and we were telling him about Train the other day. He's tracked us a little bit over time, and he is so excited to get a hold of it, and he's gonna take it out. He wants to be the first one to launch it in Europe, and I think he probably will be. So that's a lot of high-level people are waiting for that to happen. We've got a very large Forex company that's banging on our door to get that done. So it is really going to be unique. I think it's going to be a lot of fun, and you're going to have input on that too. So if there's things that you'd like to see on there, we obviously can't accommodate all the requests, but we're certainly willing to listen. So yeah, I think you're going to like what you see. And then the second question is, what do we see happening in the markets? Well, I would say that Australian dollar is interesting right now, by the way, as a possible shorting opportunity. I don't know if I'm at the signal point yet. And Thomas, How much are you just risking the previous highs there, Thomas, for that? It is
Risking a
overvalued.
few ticks beyond the previous high.
Okay, so it is overvalued right now, moderately overvalued. So I don't, yeah, for me, let's see, I'm going to keep an eye on that. It's an interesting market. Let's look at a 30-minute there. We do have a lower, potentially lower cycle finder and potentially lower histogram bar if it reverses here. Let's see here. Other interesting market, soybeans was interesting. We had a nice signal here, a nice doji, a yellow tip doji on a daily basis, but the negative here on such a longer term time frame is that you risk 20 cents off the low. So it's a really big price bar. What Thomas and I might do is we might wait for an intraday signal. So we have a buy signal end of day. We might wait for this thing to come down correct and give us a 60-minute signal, and we might look to get it, jump on that on the long side. So those are just two things we're seeing right now. So I think those are any ones you see out there, Thomas, that you find interesting? I think Thomas is, I don't know if he stepped away to grab a drink of water. So that's
Sorry,
it.
That's my mic muted.
Okay, sure. Yeah. Anything interesting you see beyond that?
Gold on a 240-minute chart is a great bullish divergence, or it was. We sent out an alert on signal feed about that and about trying to go long gold near the lows of yesterday as support.
So 240?
Yeah, and if anyone took that, we sent that out, like I said, via signal feed.
Nice.
Then they're up, what, $400 a contract or so.
Okay, so that
was.
Yeah, so you see the strengthening here of the downside momentum we've been talking about. So that might be a nice one there. I like that. And you don't have to risk a lot. You just risk the lows here, probably, Thomas. So the lows over here, would you say? Actually, if you got in earlier, earlier people got in. They're already in the money by $4 an ounce.
Yeah,
low at that point
they could have break-even stops.
Yeah, low at that point, you're risking $1 or $2 an ounce. That's beautiful. So that's in a nutshell. If you're interested in learning more, I would say check out the live trading room. We have visitor days twice a month where you can come in for free on a Wednesday. Or I would say that, in my humble opinion, I think you'll find that it adds a lot of value, and the price tag is really relatively inexpensive. Go to ValueCharts.com and check it out, and just sign up for a month. Try it out. So I think you'll like it. I have not heard a single person so far say anything but very positive things about the work Thomas is doing. So, but you know what, Thomas is a new guy who's grabbed the bull by the horns. He has has been investing for quite a number of years. He's passionate about the space, and he's teaching me things. Here I am, the guy who invented value charts, and Thomas is teaching me new ways to use it to trade. So it's great. I'm having a ball with it, and other traders are as well. It's neat to see that people just find new and innovative ways to use the technology.
Jack, train will not be demoed at the New York Traders Expo, I do not believe.
No, that's
I look forward to meeting you.
Yep, we certainly will. We will be there, and train, I'm hoping, will be out to be reviewed at some point in the second quarter. So, and it's going to be coming in stages. It's a huge project. So
is train an auto trader is another question mark.
Yeah, we're going to have some aspects of train that are rule-based automation. So, yep. And that's frankly part of the one aspect I'm very excited about. So, all right. Well, any more? If we want to take one more final question, are we good to go?
So maybe the Dallas show.
By the Dallas show, I don't know if we're going to go to that this year or not. That was a very lightly attended event last year, and even though it's right here in our backyard in Texas, our primary office is in North Carolina. So I don't know if we're going to do that this year or not. We're undecided on that. But by that time, I think you'll see some sort of prototype of train out there. So by the time the Dallas show comes around. All
right, that looks like it's all the questions for now. We do have another one of these in the future, just like you said.
Yeah. But by the way, if for some reason we didn't answer your question, please, I apologize for that. That's not we want to be thorough with these types of things. But if we didn't answer it, please be patient with us and feel free to come to our next Q&A event that's upcoming. Bring your tough questions. If you want to actually crunch numbers or look at different markets or talk about how do you optimize a system or that type of thing. Anything you want to talk about with the markets, we will talk about. So
Also, if you want to ensure that your question gets answered, send it to feedback@microquant.com before the next Q&A, which I believe is in 2 weeks. But yeah, if you send that to feedback@microquant.com, and we will make sure we answer that during the next Q&A.
All right, well, folks, we appreciate your time. It's always great to have everybody here, and we are excited about everything that's going on with MicroQuant and ValueCharts. Be sure, again, if you haven't checked out the live trading room or signal feed, I would recommend you check it out. The ValueChartist newsletter also is designed to give you a little bit of a snapshot of maybe a longer-term perspective on some exciting things we're seeing happening in some markets and some trading potential opportunities that are long-term based. And then, as always, we have some exciting workshops coming up as well. Thomas is doing one in the future that I'm really excited to see on divergences, isn't it, Thomas? The one that's
yeah, we're going to be talking about just divergence trading, different ways to do it.
Yeah, I can't wait to see that.
Another one of my favorite ways to trade. Candlesticks probably my top reversal patterns, but divergences work extraordinarily well as well. And as you know, if you're in the trading room, we trade them all the time.
Yeah, so that will be a great workshop, and we try to price our education and technology to make it reasonable. And my philosophy is if we are successful at hopefully really showing you different ways of using it. Obviously, one good trade can generate several $1,000s and put you in the driver's seat with covering the cost of these things. So. They should, the design behind it is to try to make it so it's reasonably priced and one good trade to pay for these things. So keep that in mind. I'm also going to be conducting a soup to nuts rule-based trading creation. That's really my forte is creating trading strategies and indicators. And so that's I like strategies quite a bit. So if you're wanting to learn how to create it from soup to nuts, how do you start and what's a parameter, what's a variable, what are some things to watch out for, how do you determine stop logic, how do you optimize it, what are some of the pitfalls associated with optimization. These are all things we'll go over in that event, and that's going to be, I think, at some point in early March. So that should be on our website hopefully in the next couple of days. Otherwise, I know a lot of you folks are on East Coast time, and Thomas and Brad and Christina, thank you very much for coming and attending, and we know that it's way past your bedtime since all of you are up very early tomorrow morning. And everybody else who attended, thank you very much. We appreciate your time, and we look forward to seeing you at the next event. New York, maybe the next event, actually. So we'll see a lot of you in New York. And I'm going to go ahead and close with that. Thomas, you want to go ahead and start?